Could chasing growth be costing you? When it comes to property, I see a lot of people talking about growth, but not many people seem to talk about what it actually costs to hold a property. And if you're buying a property for a long-term plan, then it's not about what it's going to cost you in the next 12 months. It's more about what's the cost going to be over the next 10 to 12 years or more. And that means that you've got to hold that property through potentially a whole lot of different situations like rate rises, changes in income, changes in circumstances. So what I wanted to show you was a couple of examples of, different common sort of strategies people are using and potentially the costs that are associated with that, and then stress test those ideas to show you how different situations can have an impact on those numbers, and why it's potentially, before you go and do anything property-wise, it's actually worth maybe stress testing your ideas before you jump in and buy. Anyway, let's jump into it. Okay, so look, first off, let's have a look at an example. What we'd go would be an atypical high-growth property. Obviously, some periods you're going to do better, but we're saying like a long-term sort of capital growth rate of 9%. This is probably something more in a metro sort of area. So the price point tends to be a bit higher, the land price tends to be a bit higher as well, but what you're generally going to find is your yields often aren't quite as strong, so therefore there's going to be a bit more cost to carry in terms of what's going to be going out of your pocket. So we scroll down to the bottom, without getting too hung up on all these numbers, we can see your estimated after-tax holding cost on a property like that could be around about $17,000 to $17,500 a year. Like we can break that down to weekly, which would be about $335 a week. So that's basically after tax what would be going out of your pocket. And look, if you're in a fairly good position, you've got pretty decent income, you might look at that and go, okay, that's a reasonable cost that I could carry, because I guess the trade-off would be if you're getting that growth, you're paying out around about 7.5 down here, but the trade-off is you may be picking up around about 80 grand a year in capital growth. Overall, you're coming out ahead. So that might be a pretty reasonable scenario, and that would be probably the typical scenario where someone's going for a more metro area, potentially a higher growth sort of strategy. I guess the thing is, and this is not saying what's right or wrong, that's based on the scenario as at now. The main thing is what happens if some things change, how are those numbers going to look? For example, if we ended up getting some rate rises in there, and let's say things jumped up 1%, it's the RBA, who knows? There's certainly talk that there could be some more rate rises coming. So if rates ended up jumping up 1%, let's say if you were sitting on 6 and it goes up to 7, then suddenly your after-tax holding cost has jumped by about 6,600. That's a pretty reasonable jump in terms of holding cost per year, or $465 a week. I guess before, where you were looking at maybe about $335 a week, you're now having to basically find effectively another sort of $120 a week in holding costs, which if you were already pretty much at your maximum before, then that can start to be a bit of a stretch as well. The other thing is other factors, and which I've touched on previously, things that can happen. If you're on a good income, but you've got a component of your salary that's basically going to be a variable component, which might be like bonuses or overtimes or those sort of things, and we end up hitting a period where the market slows a bit in terms of activity and some of that variable income drops away, then that can be another impact. So let's say if you're on 150 and then you drop down by 20 grand in terms of bonuses down to 130, so still on good income, but what that could do is push you down into that next tax bracket, and basically even just that slight change from being in that sort of higher tax bracket to down into that next level can change the numbers for you a little bit as well in terms of how much tax you're getting back. So suddenly, like, we've probably crept up about another grand in after-tax holding costs as a result of that. So I guess if we jump back to where we were looking at 6%, basically we had 6% and we're all 150, so 335, and then I guess potentially jumping up to 485, basically about 150 week jump in terms of just those two changes alone. Probably just highlights again before you jump into these things, have a bit of a sense of not only what the numbers are looking like today, but how's that sort of going to play out long term if you're looking at a longer term hold. Okay, so that's probably your typical sort of high growth sort of strategy in let's say a metro area. So why don't we have a look at what I'd call would be a lower hold cost option. So this one's actually a real example. So this is a property one of my clients that's recently gone ahead with. Just to give you some background, it's actually a dual income property. So it's got two income streams offered, so ends up with a high yield. So that certainly helps with the cash flow. And the other thing is you tend to find with the duals the depreciation level's a little bit higher as well. That can bump up some of your after-tax benefits. So both those two things combined end up with basically driving that sort of after-tax hold cost down a little bit. So based on the numbers for this one, the actual after-tax holding cost is basically about $2,300 a year. Basically equates to about $45 a week in terms of holding costs. So a pretty easy hold for most people in terms of that. I guess if we compare that to the metro type property where the holding cost start point was about $335, so you're obviously substantially below that. But let's have a look at what happens when we run that same scenario through with the change in rates. If we bump that up, if we bump that up by up to 7%, then you can see that jumps up the after-tax hold cost by a fair bit. So we went from about $2,300 a year up to about $8,000, and that nets out to basically after-tax cost of about $154. So definitely a jump from where you were. But in terms of, I guess, if you contrast that to the start point on the other property was $335 and we've gone to $154, then you're basically at around about half that cost of that property, even with that rate rise. So obviously, if you're in a situation where you can go, I could manage $300 or $400 a week, then obviously, the 154, yes, you'd love it to be 45 as opposed to 154, but it's probably not going to force your hand to have to take any drastic action. You can probably at least ride that situation out until rates come down. If we change the income level, so again, like we said, if that income actually dropped and pushed you down into the next tax bracket, down to 130, then that obviously takes up that after-tax hold cost again, because again, you've lost a little bit of that tax benefit, and that sort of pushed you up by about another $25 a week. Again, an increase from where you were, but I guess in terms of contrasting it to the other example, you're still well below that. So probably pretty manageable. The key thing with this is just showing two different examples, two different scenarios. But I guess the main point I'm trying to illustrate there is if you're looking at property, particularly if you're going to be aiming to hold that property long term, then you need to be thinking beyond the next 12 months and more the next 12 years or so in terms of how things could play out. And obviously we know if we look back over the last 10 years, there's been lots of different changes in the market, different cycles, etc. And it almost seems every 7 to 10 years some event comes along, like a GFC or a COVID or whatever it's going to be, that creates some market upheaval as well. So in terms of looking at strategy, particularly if you want to hold long term, you need to be thinking about what other factors could come along and maybe stress test what you're considering, rather than just taking it on, hey, look, these numbers look great today, because that might be the ideal situation, but you've got to probably think a little bit beyond, okay, but what if things aren't ideal? What if things change? So the good thing is stress testing a few things as well and seeing if that's still comfortable, and if it is, after you've done that, then you're probably fine to go ahead and jump into that. But if it's making you a bit uneasy, then maybe that makes sense to pause for a moment and go back and have a relook and maybe rethink your strategy. The other thing too, in terms of not just your holding costs on one property, but also to be mindful of, if your plan is to potentially build a portfolio, then obviously if you've got high hold costs there, that could potentially be a barrier to going forward, particularly if some of those costs jump up, like if we get a rate rise or that change of income, like I said, with those hold costs going up, that might be a barrier to moving on to that next property if that was part of the plan. So again, that could be a reason to maybe rethink your approach as well. And particularly if you're going on wanting to part of my plan is I need to build more, basically to build more than one property effectively, then that first property becomes pretty critical in that, and potentially looking at a lower cost hold might be a suitable option as well. Anyway, so I hope you found that information helpful, and I look forward to seeing you in the next video.